Hello everyone, you're very welcome back to the channel. Let me ask you a question. How was I able to invest in over 100 real estate projects spanning 25.1 million square feet across 12 states in America, all for just €100? That's enough commercial real estate to fill 386 American football fields. Now, clearly I don't own 100% of this real estate, but I do have a very small ownership interest in the real estate itself, and I was able to obtain that interest for €100. The answer? An investment vehicle that allows any investor to own a small piece of a large collection of physical real estate, the Real Estate Investment Trust, or REIT. The specific REIT that I refer to in the intro is Federal Realty Investment Trust, who also happens to be the only REIT on the list of dividend kings. REITs allow investors to own physical real estate without having to own and operate the physical properties themselves. Because of this, REITs are seen as an alternative option for those looking to become private real estate investors. REITs are going to be the focal point of this video. I'll explain what REITs are, how they operate, and the pros and cons of REITs as opposed to direct real estate investing, because ultimately that's the most important question to ask. Am I better off investing in real estate directly through physical property ownership or indirectly through ownership of REITs? If after watching this video you do want to get started investing in REITs but you don't have a brokerage account, you can try out brokers like DeGiro, BookZero, Trade Republic, or Trading 212 using the links in the video description. If you want to learn which of these brokers is the best broker for European investors, check out the video popping up on screen after this one. Alright, let's kick things off with the obvious question. What is a real estate investment trust? A real estate investment trust is a company whose business involves the ownership of real estate. The REIT will acquire or build real estate, and this real estate is what makes up the REIT's portfolio. So naturally, the first way in which a REIT creates value is by acquiring or building properties which subsequently appreciate in value. But a REIT doesn't leave its properties vacant. A REIT will lease out its properties to tenants. That, in turn, will generate rental income for the REIT, and that's the second way in which a REIT creates value. So when you're investing in a REIT, you want to see property valuations going up and rental income from tenants flowing in. The same expectations as you'd have as a landlord. Real estate investment trusts can operate in many different sectors such as retail, healthcare, data centers, and residential. Commercial REITs, like those operating in the retail sector, will lease out their properties to businesses who wish to operate from that property. For example, Simon Property Group is a real estate investment trust that invests in shopping malls across the United States. The REIT will own the shopping mall and it will collect rental income from all of the businesses that operate out of the mall. Residential REITs will lease out their properties to individuals and families who are in the rental market. No matter what sector the REIT operates in, the premise generally remains the same: collect rent, own appreciating properties. But is that all there is to it? Are REITs just corporate landlords and nothing more? While that might be the gist of a REIT's business model, there are some features of REITs which set them apart from other companies and private landlords. In the US, and indeed in Ireland and other countries around the world, REITs are exempt from corporation tax. In other words, REITs don't pay tax on the rental income that is collected from tenants. As well as this, REITs don't pay tax on any gains made from selling properties within their portfolio. So what you have is a company that doesn't have to pay any taxes on its profits or gains. Clearly, this is very beneficial to the company and indeed a very favorable status as compared to the tax status of private landlords. But there is a catch. In order for a company to be classified as a REIT and to obtain this tax status, it must meet certain requirements that are set out in the tax law of the country in which the REIT is operating. I'll read out the requirements for both Irish REITs and American REITs, and you'll be able to identify the parallels quite quickly. In order to be classified as a REIT under Irish tax law, a company must A. derive at least least 75% of its income from property rentals. B, have at least 3 properties. C, maintain a ratio of 1.25 to 1 between rental income and financing costs. D, derive at least 75% of its asset value from rental properties. E, maintain a loan to value ratio of not more than 50%. And F, distribute at least 85% of its rental income annually by way of a dividend to shareholders. In order to be classified as a REIT under American law, a company must A, distribute at least 90% of its taxable income to shareholders annually in the form of dividends. B, invest at least 75% of its assets in real estate and cash. And C, derive at least 75% of its gross income from real estate related sources. There are other requirements, but those are the main ones that I wanted to highlight. In both cases, the law ensures that the company is predominantly engaged in a real estate business and that the majority of its cash flow is coming from that business. The Irish tax law puts specific limits on how much a REIT can borrow when financing new properties, whereas the US legislation does not. This is no doubt a macro-prudential policy in the wake of the financial crisis to protect lenders, REITs, and REIT shareholders from excessive debt. Therefore, in theory, American REITs could provide investors with exposure to much higher levels of leverage than REITs situated in Ireland. UK REITs are also subject to debt restrictions. But the most interesting obligation imposed on REITs is the obligation to pay out the vast majority of its rental income every year to shareholders. The figure is 85% of income in Ireland and 90% of income in the US and the UK. This is what makes REITs such a unique and attractive investment, specifically for investors who are looking for dividend-paying investments. REITs are required under law to pay out dividends to shareholders, whereas normal companies aren't obligated to pay a dividend. But a REIT's dividend isn't just any dividend. It's a dividend that represents upwards of 85% of the REIT's income. So when you invest in a REIT, you're doing so for the dividend first and foremost. This is the part of the video where we compare investing in REITs to investing in real estate directly, because if you think about it logically, they are two means to the same end. When you invest in a REIT, you're becoming a part owner of the company. That means, like any corporate investment, you are entitled to a portion of A, the net assets of the REIT, which is largely the equity value of the REIT's property portfolio, and B, the future income of the REIT, which is comprised of rental income from tenants. So as an investor, you make money from the REIT's properties appreciating in value relative to debt and from rental income collected from tenants. Contrast this to direct real estate investing. When you purchase a property with the intention of leasing that property, you have two commercial goals. Number one, collect rental income from the tenants of your property, and number two, benefit from appreciation in the property's value. Both REITs and direct real estate investing have the same two commercial goals. So that begs the question, which avenue is better? As we mentioned, REITs allow investors to gain exposure to real estate without having to own and operate the physical properties themselves. The REIT investor has zero involvement with the running of the REIT's business. He or she simply holds his or her shares, collects a dividend, and gets on with life. This is a stark contrast to investing in real estate directly. As a private landlord, you have to consider property taxes, solicitors, real estate agents, banks, insurance, and worst of all, tenants. Choose the wrong tenant and your investment returns could evaporate. Yes, that's also true for REITs, but as REIT investors, we can easily see the rent collection and occupancy rates of a given REIT, so we can compare REITs on the basis of tenant quality. Plus, REITs typically have large and diverse portfolios with many tenants and dedicated management teams to manage those tenants. As a private landlord, you're on your own. You have to choose your tenants wisely. Choose wrong and it could cost you. Yes, you could hire a property management firm, but that too eats into investment returns. The biggest differentiator between the two avenues is the cost. If you want to invest in a property in Ireland for the purposes of letting and you require a mortgage to buy that property, you need to have a deposit equal to at least 30% of the value of the property. In other words, if the property is valued at 400 grand, you need to have at least 120 grand down in order to secure the mortgage. That's just the entry cost. You then have to consider the recurring cost of the mortgage, which is the interest. Contrast this to REIT investing. investing. With the advent of fractional shares, you can invest in a REIT for literally as little as €1. By doing so, you've just secured yourself exposure to physical real estate. Also, because shares in REITs are traded on the stock market, the liquidity is much higher than direct real estate investing, i.e. you can enter and exit the investment with much greater ease. So the barriers to entry for investing in REITs are nowhere near as high as the barriers to entry for direct real estate investing. Now, you could argue that direct real estate investing offers greater access to leverage, which is true, especially when compared to REITs based in Ireland and the UK, or any country that imposes debt restrictions on REITs. Private landlords are typically going to have a lot less equity in their properties than REITs. That, in turn, opens up the potential for large gains for the private landlord if the property appreciates in value significantly. Emphasis on the word if. But it works both ways. If the property depreciates in value and the investment is highly leveraged, the private landlord stands to lose a lot of money. So how do you decide between REITs and direct real estate investment? Well, you could look at the data. Have historical returns been better for REITs or private landlords? Data from a REIT study highlighted that REITs outperformed private real estate both during and after the last 6 US recessions. REITs also outperformed the equity markets before, during, and after the last 6 US recessions. We also know that in all but 2 of the last 20 years, US REIT dividend growth has outpaced inflation. 2 very positive data points for REITs, but of course that's just the US market. Given the varying nature of global real estate, what's applicable to the US might not be applicable to your local property market. However, there are a couple of relatively simple questions that an investor can ask him or herself when deciding between REITs and direct real estate investment. Question 1. What is the average annual total return after taxes and inflation that I can reasonably expect from a high quality REIT? Question 2. What is the average annual total return after taxes and inflation that I can reasonably expect from investing in my local property market directly? Note that question 2 requires you to estimate A, the average annual price appreciation or depreciation of the property, and B, the average annual net rental income from the property after all costs have been accounted for. And question 3, what is the difference in expected return between the 2 options? If the results are in favor of direct investment, is there enough of a difference in positive return to justify the significant contrast in workload and barriers to entry when comparing both options? Note that the reason why it's important to compare the after-tax expected returns of both options is because the tax law applicable to your jurisdiction might tax these sources of income differently. A higher tax rate may apply to dividend income as compared to rental income. Certainly, the private landlord will be afforded many tax write-offs that he or she can avail of to reduce his or her taxable rental income, and these should be accounted for when comparing both options. Another consideration is foreign currency risk. If you're going to be investing in American REITs as a European investor, your net returns will be impacted, for better or worse, by fluctuations in the value of the US dollar relative to the euro, pound, or whatever currency you use. That needs to be accounted for. Options to avoid this risk would include A, solely investing in REITs that operate in the same currency as your home currency, or B, investing in a REIT ETF that offers hedge share classes to mitigate currency risk. Anyway, I hope that this discussion has given you something to ponder, specifically if you're someone who is thinking about investing in real estate, or if you're someone who has always wanted to invest in real estate but has never had the means to get involved. Let me know, what are your thoughts on both REITs and direct real estate investing? Are you engaged in either? If so, what has your experience been like so far? If not, would you consider doing so in the future? If you want to get started investing in REITs, make sure to check out DeGiro, Book Zero, Trade Republic, or Trading 212 using the links in the video description. Using these links helps me out as a creator, and it lets me know that you found this video to be helpful. You might be interested in this next video where I talk about the best S&P 500 ETFs for European investors. Thanks very much for watching, and I'll see you soon.